Welcome to the debate. Today we're undertaking a very focused, investor-centric analysis of Taiwan Semiconductor Manufacturing Company, or TSMC. This is, and I don't think it's an exaggeration to say, a critical infrastructure business that really underpins the entire global digital economy. Before we dive in, we have to frame this by accepting two truths. This may be one of the best semiconductor businesses ever built, but it is absolutely not a simple or low-risk investment.
I think that's the perfect way to frame it. The complexity here really forces us to define what factors, truly determine its long-term viability. So that brings us to our central question. Is TSMC's continued success fundamentally dependent on its deep technological and operational moat? Or are the external, systemic factors, I'm talking about staggering capital requirements, fierce competition, and, of course, profound geopolitical vulnerability, are those the primary determinants of its fate?
My position is that TSMC's core competitive advantages, which are, deeply rooted in its technology and its unique business model, are durable enough to continue insulating it from those external risks. The moat is just so deep that they can maintain pricing power and robust returns for the foreseeable future.
And I'll come at it from the other side. I'm going to argue that those non-technical, external pressures are mounting to an unsustainable degree. The sheer scale of capital required just to maintain that lead, coupled with geopolitics and execution risks in its global expansion, means the external constraints now, I believe, outweigh the internal excellence. This isn't just a technology story anymore, it's a capital and risk management story.
Okay, so let's first articulate the nature of that excellence. TSMC's success really is rooted in what I call its trinity of strengths: technology leadership, manufacturing excellence, and, this is crucial, customer trust from its pure-play foundry model. This dedication has created an utterly dominant scale. For context, in 2024 alone, they manufactured the equivalent of nearly 13 million 12-inch wafers, supporting almost 12,000 different products for over 500 customers. That sheer volume creates learning curves that competitors simply cannot replicate.
That scale is breathtaking, I agree. But I'd argue it's also become a necessary evil. It's a scale that's predicated on continuous defensive investment. And that brings me right to the core risk: capital tension. The massive continuous capital expenditure just to stay one generation ahead is financially staggering. We're talking about building a single 3-nanometer fab that costs an estimated $15 to $20 billion.
But the payoff for leading the market is enormous.
It is. But the risk if they misstep is existential. The annual operating cost for that single fab runs up to $2 billion a year. The depreciation cost alone is estimated at up to $5,000 per single wafer. So TSMC plans to invest over $30 billion in 2025 alone. If market demand slows even a little, if utilization rates drop from, say, the high 90s to the 70s, profitability breaks down. And it breaks down fast because of these massive fixed costs. The capital requirements create a real fragility.
But that investment is the barrier to entry. It's what creates the moat. And you can see it in their quantifiable technology lead, especially in advanced nodes for HPC and the AI markets. Their new 2-nanometer process, N2, which introduces the next generation of transistors that gate-all-around FET, or GAFET, is progressing incredibly smoothly.
Certainly, it's a monumental technological step up from the previous architecture, FinFET. So imagine a FinFET transistor has 3 sides where the current is controlled. GAFT, by contrast, wraps the gate entirely around the channel. This maximizes the surface area for better control, and that drastically reduces leakage and improves switching speed, which is exactly what modern AI accelerators desperately need. And back to my point on execution. TSMC's current yields for this brand new N2 tech are already around 65%, with projections to hit 75 to 80%. To get to 65% yield so early in a completely new architecture like GAFT is, frankly, astonishing. It gives them superior time to volume and lets them lock in clients like Apple and NVIDIA immediately. And then you have to talk about how they're capturing AI growth by expanding advanced packaging, specifically CoWoS capacity.
It's a sophisticated way of stacking multiple chips like a processor and high-bandwidth memory into a single package. It's absolutely essential for AI chips like NVIDIA's because it allows for dramatically faster communication between the components. TSMC is the undisputed leader here, and the AI boom has created a massive bottleneck in CoWoS capacity, which they are now aggressively expanding. AI demand drives demand for their highest margin products.
That's a powerful point on the tech, but let's talk about the economics of maintaining that lead. This brings us to the commercial durability of that pure play model you mentioned. You see it as a source of trust, but I argue that the fabless foundry dynamic is actually being inverted by their major customers. Hyperscale platforms like Google, Apple, Microsoft, they're leveraging their immense scale not just to design their own silicon, think Apple's M series or Google's TPUs, but to optimize the entire system. This vertical integration among TSMC's biggest clients creates a material concentration risk. If a credible competitor emerges, one or two of those major customers could easily diversify their manufacturing or push down prices. Their motivation isn't trust, it's performance and cost control.
I see why you'd characterize it as a threat, but I think even the most vertically integrated giants still have to turn to TSMC for the hardest steps, the 3 nanometer, the 2 nanometer. Why? Because the sheer complexity required to get high yields, where defects are literally measured in a few misplaced atoms, it means TSMC is indispensable. Nobody else has that institutional knowledge. And beyond that, the pure play model has evolved into an ecosystem lock-in through their Open Innovation Platform, or OIP. This isn't just about design tools. OIP is the foundry segment's largest design support ecosystem. It has IP partners, cloud alliance partners, including the hyperscalers themselves. It lowers the barrier to design complex chips, which keeps innovation flowing to TSMC. And it dramatically increases the cost and time for a customer to even think about switching. The switching cost is enormous.
Customer lock-in is powerful, I'll grant you that, but it relies entirely on TSMC staying definitively ahead on the roadmap. If that lead is challenged, the whole structure becomes vulnerable, which brings us to the intensity of the competitive threat.
Well, TSMC has the financial position to sustain that race. Their gross profit margin was 56.1% in 2024. That is just a huge number. They have immense pricing power. Wafer prices for advanced nodes more than doubled, going from 7 nanometer to 3 nanometer. That's a sign of a monopoly on capability. And their current N2 yield lead of 65% gives them a crucial time to volume advantage that secures the most lucrative contracts early on.
I'm not convinced those historical margins guarantee future dominance. That lead is now under the most serious threat it has faced in over a decade, specifically from Intel. Intel is aggressively targeting the 2 nanometer equivalent, their 18A process, by late 2025. And this time feels different because they're investing heavily in next-generation high-NA EUV lithography, securing all the available machines until 2025. If Intel successfully executes on its timeline, TSMC faces real competition for the first time in advanced logic. And Intel doesn't even have to surpass them to cause trouble. They just have to be close enough to be a credible second source. That would immediately put enormous pressure on TSMC's coveted margins and demand even more capex just to stay level. It changes the whole investment thesis.
That is still a massive if. I mean, Intel has a documented history of execution delays and ambitious timelines that just haven't materialized. TSMC, on the other hand, has demonstrated relentless, decade after decade execution. They're already planning the enhanced N2P process for 2026 with backside power delivery. They are always focused on extending that leadership. The threat is real, but history favors TSMC's execution.
Execution is precisely where my biggest non-technical concern lies. Let's pivot to geopolitics and capital allocation. The reality is that the advanced technology, the core R&D for NDP and A16, it all remains overwhelmingly concentrated in Taiwan. This forces TSMC to embark on these risky, massive global expansion projects purely for geopolitical risk mitigation, not for economic efficiency. Look at the Arizona fab investment, planned at $65 billion. It's an enormous commitment, but is still lagging in capability compared to what they can do in Taiwan. And this diversification faces serious operational headwinds. Reports cite severe skilled labor shortages. We're talking a projected 300,000 U.S. shortage by 2030, constant delays, and deep cultural clashes.
What do you mean by cultural clashes in a foundry environment?
I mean, the inability to replicate the unique work cadence and engineering culture that makes TSMC so efficient in Taiwan. The long hours, the intense management style that achieves those world-leading yields, it's just not translating well. Morris Chang himself said that running leading-edge operations outside of Taiwan doesn't make pure business sense because you can't replicate that workforce. It is fundamentally harder, slower, and more expensive everywhere else, and that pressures your long-term returns. And all of that expense just leads us back to the core, non-diversifiable risk. In the event of a severe China-Taiwan geopolitical shock, a blockade, or an invasion, experts assume TSMC would be rendered inoperable, either from sanctions or physical damage. The core asset, the crown jewel, is located in the world's highest risk area. It's a severe, permanent threat that has to be weighted heavily.
Framing the Taiwan location as purely a vulnerability, though, ignores the strategic context. Diversification to Arizona, Japan, and Germany is a necessary insurance policy, driven by customer demand for supply chain redundancy. The strategic caution is what allows TSMC to remain the world's most reliable provider. And we also have to consider the silicon shield. The immense global reliance on TSMC, the fact that shutting it down paralyzes the world's economy, that acts as a massive deterrent. It provides Taiwan with a degree of protection through economic interdependence that is profoundly valued by the U.S. and its allies. So the presence of TSMC isn't just a risk, it's a strategic asset that provides diplomatic leverage.
The shield may deter a full invasion, but it doesn't prevent gray zone pressure or a blockade, which would still halt global capacity overnight. This is a risk that requires constant monitoring of the political environment, which is, pretty far removed from the core technological advantages of the business.
We both agree, then, that the sheer complexity here demands that investors monitor both the technical roadmap and the surrounding political and economic environment with equal rigor. My thesis remains that the underlying strength of TSMC's operational excellence, you see it in their yield rates, the speed of their N2 and A16 execution, their customer alignment, it all means the long-term investment thesis remains intact. For the success story to continue, what has to be true is continued technical leadership and aggressive investment in advanced packaging like CoWoS to capture AI growth.
And my argument is that the thesis hinges less on that internal technology and much more on managing the external pressures that drive up capital costs and geopolitical volatility. What would invalidate the thesis is a failure in capital discipline, heavy spending that leads to low utilization, or a material geopolitical shock. Investors have to monitor utilization rates, success metrics for the global fabs, and any sign that a competitor like Intel is actually executing on its 18A roadmap. That would immediately threaten TSMC's pricing power.
Indeed. This is an investment where the difference between technical superiority and existential fragility is measured in tens of billions of dollars of continuous capital investment and the continued stability of the Taiwan Strait. The listener has to weigh the dominance of the moat against the magnitude of these external risks.
It is the ultimate trade-off, demanding a sophisticated understanding of both semiconductor physics and, geopolitics. Thank you for this discussion.